Investing doesn't have to be expensive, confusing, or complicated. You want the basics conveyed in a way that is easy to understand. I'm your host, Lena, partner at Sensible Portfolios, and this is our podcast inspired by real investors who want to pay less, earn more, and retire better. Welcome to Retirement for Real. Today's discussion is about how to invest for your retirement portfolio. Now, this can be a complicated topic, but when you understand some basic principles, you'll be surprised how easy it is to construct a simple and effective retirement portfolio. So for starters, ask yourself, what actually matters in your investment portfolio for retirement? Well, first, know that there are factors you can control, and there's factors that you can't in investing. How the market performs, for example, is out of your control. Markets are moved by tomorrow's news, and you can't predict what that news will be. So whether it's geopolitical events, earnings reports, or actions by the Federal Reserve, none of these are really within your control, so we don't focus on them. Now, on the other hand, there are things you can control, and here's the good news. These factors can and will significantly impact your investment returns. So these are things like your asset allocation, how diversified your portfolio is, the fees and expenses you pay, and the taxes that you incur. So we're going to talk more about each of these factors because, again, these are what actually drive reliable returns in your portfolio, not the outside factors. Okay, so what is asset allocation? Simply put, asset allocation is the way you divide your investments across stocks, bonds, and cash. Holding the right asset allocation across these asset classes is important because doing so will help you earn the best return for your money without taking on too much risk. Now, your allocation is personal to you. It really depends on your time horizon and your overall comfort level with risk, how well you can stomach the ups and downs of the market. When you're retired and you're drawing down on your investments, a conservative allocation is appropriate. So you're investing in safer investments, mainly bonds as opposed to stocks. Now, according to Vanguard, how you decide to allocate your investments will have the biggest effect on the way your portfolio will act. So if you learn anything from today's episode, know that it is critical you understand your portfolio's asset allocation. Let's say you hold 70% of your portfolio in bonds and the other 30% in stocks. Now, you don't want to own just one bond or just one stock. You'd rather own lots of different individual investments. So when one investment underperforms, it can be offset by the outperformance of another investment. So this is the concept of diversification. It's the whole idea of not putting all your eggs in one basket. When you diversify your portfolio, you can better manage your returns because what you're doing is effectively minimizing certain types of risk. A well-diversified portfolio not only includes a mix of different asset classes like stocks and bonds, but furthermore, your stock investments are diversified between domestic and international stocks. And your bond investments should include a mix of government-issued bonds and corporate-issued bonds, as well as long-term, short-term bonds. You get the idea here. Over the long term, we do this because it's impossible to predict which will outperform. Having a portfolio with sufficient diversification will help moderate volatility and generate higher returns. And get this, if you have a portfolio that is properly diversified, a stunning 88% of your investment experience or your volatility of your portfolio and the returns that you earn can be attributed to your asset allocation. Now, once you've locked in the appropriate asset allocation and you've ensured you have diversification, you next want to look at the fees and expenses you're paying. Now, this is super important, and don't just take it from me. John Bogle, the iconic founder of Vanguard, he says this. He says, in investing, realize that you get what you don't pay for. Bogle rallied against the high cost of investing because he knows investment expenses, which include your commissions, advisory fees, and the fees charged by mutual funds, directly erode your investment returns. He also knows something the financial services industry doesn't want you to know, and something that they try really hard to cover up with things like complexity and exclusivity. And this is that investments with lower costs historically have outperformed more expensive ones. You would think paying more for a certain investment or a certain mutual fund would be a better or more successful investment. After all, you're paying a premium, right? Well, history tells us this isn't the case. Now, paying higher fees has another, more subtle cost. The money you pay in fees isn't invested and therefore doesn't benefit from compounding over time. You lose all the growth that money might have had for years into the future. So over time, this opportunity cost can be significant. Don't forget, the fees you pay your financial advisor also add up over time. So for some investors, using a low-cost financial advisor not only may meet your needs, but will certainly improve your long-term returns. Another expense to consider are your taxes. Investments within your portfolio, as well as the different types of investment accounts, have different tax impacts. When comparing, say, index funds and actively managed mutual funds, there's a significant tax difference. Index funds attempt to mirror the returns of a designated index, while actively managed mutual funds attempt to beat said designated index, and they use expensive money managers to select the investments. Given the impact of taxes and fees, an argument can be made to limit your investments to low-cost index funds or passively managed mutual funds. Index funds usually distribute fewer capital gains because there's less turnover happening in the portfolio. Actively managed funds often generate more taxable capital gains because of the higher turnover, that buying and selling that's happening within the portfolio. Consider a one-fund portfolio. This would be like a low-cost target date fund from a fund family like Vanguard, Charles Schwab, or Fidelity. Now, these funds are great. They're diversified and they automatically rebalance as you age, so they're practically hassle-free. If you want more control and something more personalized to you, another attractive option is a two-fund portfolio. Now, the funds within this two-fund portfolio might include an all-world stock ETF, like Vanguard's Total World Stock ETF. The bond portion of your portfolio, you could consider Vanguard's Total Bond Market ETF. Both ETFs track a very broad market-weighted index with very low costs and low expense ratios. Now, all of this is to say there are many factors to consider when deciding on an investment retirement portfolio. Your portfolio is dynamic, not static, so understand over time you'll want to adjust it to accommodate your changing goals, your risk tolerance, and your time horizon. When you understand what matters and what doesn't in investing, you're well positioned to select a retirement portfolio suited to your unique requirements. That's it for today's episode. Thank you for listening to Retirement for Real. Tune in for future episodes every other week. Thank you for listening to an episode of the Retirement for Real podcast. If you're looking to learn more about how low-cost investing can help you in retirement, check out our website, sensibleportfolios.com, and click on Book a Call to speak with me or one of our advisors. This podcast is for entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast is not engaged in rendering legal, financial, or other professional services.